Hello, good morning, everyone. Hope I'm audible to everyone.
Yes, sir.
Yes, sir.
Yeah, thank you. Welcome all this morning, Saturday morning. On behalf of BILS, I welcome you all on this lecture of income tax. This is going to be the first of our lecture because it's a vast topic. Though now you have only paper where it's only 50% marks, 50 marks. But still, uh, there's some disturbance.
Book.
Please mute it.
Auto.
You just, you just mute it. Sorry, whoever it was, I don't know. I was saying that a lot of portion is covered in this, though it's only 50 marks. Now my endeavor is going to be to cover as much as possible. And I'm also going to take this up with BLS to reduce some portion because I think it may not be necessary to go through all this now. But let us see. I also want to thank our president for giving me this opportunity. And I hope that I'm able to teach something, even if it is just a basic tax law that I have knowledge of and I can teach.
Recording in progress.
Just go in this. You can say somebody's mute everyone. There's technical problems, I guess. I also want to thank my juniors who helped me with this, and in particular Atish, who's done this PPT, and my Anika, Tanika, sorry, who helped me with this PPT. I hope you all are ready. Have you had your breakfast? So concentrate on this lecture. Even if not, I know your videos are off, so possibly you may be having some breakfast, but don't have it with your video on and tempt others. So then they don't concentrate on the lecture and they go and start looking for food. Anyway, let's start. First, so Income Tax Act is an act which deals with the income of people and taxation on that income. It is, in a way, for most of us, a boring topic. But if you really practice tax, it becomes really interesting. Some of the matters that come up in courts or tribunals are really very, very interesting on points of law. So maybe sometimes our aim is to keep this in the exam also because you should have this basic knowledge of tax. It helps you dealing with your clients. It helps you in your practice. It also helps you in running your own profession as a firm because you will know how this tax affects you also. Therefore, it is an important topic and therefore we have kept it in the syllabus. I know now chartered accountants have more or less taken over tax practice. Very few lawyers are practicing tax. Even those who are practicing are more chartered accountants, and then they have done law and then they practice tax. But whatever it is, knowledge of tax is always important. So we'll start today. First of all, let's say what is income tax? That is the first question. Income tax is a form of direct tax that needs to be borne by a taxpayer. Income tax is controlled and charged by the central government of India, and it is applicable to taxpayers' income which was earned in the previous year. What do you mean by tax? I forgot to tell everyone, in case anyone has any questions, they can raise their hand. I'll unmute you. So maybe you can ask that question. So what do you mean by tax? The tax is a mandatory fee or financial charge levied by the government on an individual or an organization to collect revenue. Now, why do they collect revenue? They do it for public works like infrastructure. So everybody would by now know that some work, public work is done by the central government, some public work is done by the state government, and otherwise the local authority, local body like Mumbai Municipal Corporation. So for all these public works, they collect different type of taxes. Property tax or GST or whatever. So this tax is basically collected for public works to provide the best facilities and infrastructure. The collected funds then are used to different public expenditure programs. What is income? Since we are dealing with income tax, we've just read what is tax. Now let's see what is income. Now, income in general terms everybody will say that it is earnings, what one earns. But in section 224 of the Income Tax Act, income is defined. It is an inclusive definition and it has got 32 subsections. It describes various types of earnings by a person in various forms. Due to paucity of time and space, it is not possible to reproduce the section here. But I will generally, I hope you all have got your income tax barracks with you. If you open that subsection 24 of section 2, you will be able to see, and this is very important section, therefore you must note down this. A lot of questions could be asked in exams on this. The income includes, first is profits and gains, which you earn in a business. Dividends, what you receive from companies where you hold shares. Voluntary contributions received by a trust created wholly or partly for charitable or religious purposes. There are conditions in that. Any perquisites or profits in lieu of salary, bonus, etc. Any special allowances or benefit that you get. Then you may get a perquisite, say, by way of a motor car. Then the value of that motor car, value of benefit where it is convertible into money. For example, suppose you get shares. If you are an employee of a company and you get shares, then the value of those shares would be treated as your income. Any sum chargeable to income tax under sections 28. Then it says profits and gains of any business of banking, insurance, winnings from lotteries, crossword puzzles, races, horse races. Maybe you go on Kaun Banega Crorepati and like earn 1 crore. Then that will be also treated as your income. Any amount which you receive from an employee as contribution to any provident fund or superannuation fund or any other fund, then that is also treated as income of the employer. Then any inventory, fair market value of any inventory, any considerations received on issue of shares which exceeds the fair market value. Then there are other sections referred to in the definition. We'll be going to those sections. So basically, income is well defined, and a large portion of money is received in different forms are covered as income. Next. Now, the definition of tax is also in section 242, section 2, subsection 42. And it reads as follows: tax in relation to assessment year commencing from 1st April 1965 and any subsequent assessment year means income tax chargeable under the provisions of this Act. And in relation to any other assessment year, income tax and super tax chargeable under the provisions of this Act. Prior to the aforesaid date and in relation to the assessment year commencing from 1st April 2006 and subsequent years, assessment years includes fringe benefit tax payable under section 115WA. I know this fringe benefit is not covered in your syllabus. I think it is not in today's syllabus. But fringe benefits are basically like perquisites, which an employee gets. So from 1st April, even that is included as tax. Now the Income Tax Act, which was the Income Tax Act of 1961, governs taxation in India. It includes key provisions such as tax slabs, specifies income brackets and corresponding tax rates, deductions and exemptions, exclusions. Tax is charged on various incomes from different sources and such as salaries, investment, properties, etc. Now, Income Tax Act has been modified practically every year since it was enacted. There have been so many amendments in the Income Tax Act. Sections are added, subsections are added, substituted, deleted. The government is now thinking of simplifying the Income Tax Act, bringing out a new Income Tax Act. They have been talking since several years. I don't know when it will come out. But because of so many amendments, it has made it a bit complicated. You keep on referring to one section or the other under the provisions of the Income Tax Act. Some provisions are given earlier, some are given later. So if you do not practice tax, it becomes difficult for any person to actually understand this act. The simple way to learn this is to refer to a book called, you can note down, a book called Income Tax Ready Reckoner by B.G. Mehta. So if you're paying attention, write this. It is a good book where various sections on various topics is combined together. So you don't have to keep hunting from here to there. Provisions are simplified and explained in a lucid, simple manner in this book. It will help you in your studies for your exam. So maybe you should buy this V.G. Mehta's Income Tax Ready Reckoner book. Now coming to how income tax is being paid. So basically, income of whose income will be counted, who has to pay tax. That is the first topic we'll be covering. Income of an individual or a person. I'm using both words, individual and a person, because I will come back later to that who is an individual, who is a person. They are assessed to tax under the Income Tax Act. The word is assessed. The individual or person whose income is assessed is an assessee. An assessee is defined under Section 2, subsection 7 of the Income Tax Act. It says assessee means a person by whom any tax or any other sum of money is payable under this act. And again, the word is includes every person in respect of whom any proceeding under this act has been taken for assessment of his income or assessment of fringe benefits or of the income of any other person in respect of which he is assessable, or of the loss sustained by him or by such other person, or of the amount of refund due to him to such other person. Therefore, this inclusion also includes all these persons on whom some proceeding is taken out or to whom some refund is due. They are also assessees. And every person who is deemed to be an assessee under the provisions of this act, every person who is deemed to be an assessee in default under the provisions of this act. So by default also you can become an assessee. We will be coming and doing this topic on how you become an assessee in default. Now we come to the definition of assessee. In the definition of assessee, it referred to the word person. And person is defined under Section 2, subsection 31 of the Income Tax Act. Again, this is also an inclusive definition. It says a person includes an individual, a HUF, a company, a firm, an AOP, whether incorporated or not, or a body of individuals incorporated or not, a local authority, every artificial judicial person not falling within any of the preceding subclauses. Say, for example, a trust, which is formed under a statute. Therefore, that is also a person. Next time. Now, we come to the topic for which period a person is supposed to be assessed for his income and how the assessment takes place. So the period during which the income of an individual or a person is assessed is called an assessment year. Now this word assessment year is defined under Section 2, subsection 9. So question that arises is, what is an assessment year? So in the Income Tax Act, the income tax year is described as an assessment year. That is the year in which the income of the previous year, which ended before the commencement of the year, is to be assessed. In simple terms, if the assessment year commences on 1st April 2025 and ends after 12 months on 31st March 2026, that is AY 2025-2026, the income of the previous year, that is for the period 1st April 24 and ending on 31st March 2025, will be assessed in this assessment year. Now they have made it compulsory that your assessment year and your previous year would start on 1st April and end on 31st March. Earlier, everyone had different previous years. So assessment year was 1st April to 31st March. The previous years were different. Somebody had, like Hindus would have from Diwali, Christians would have from January to December. So that way, everybody had different previous years. and their income would be assessed in the assessment year commencing later. But now they made it as a general rule, and that everyone would have the same assessment year and the same previous year. So you earn the income in the previous year, and that is assessed in the next assessment year. Now, previous year is defined under section 234. And it says that previous year would be as defined under section 3 of the Income Tax Act. Now, previous year means a financial year immediately preceding the assessment year. As per the proviso to section 3, in case of a newly set up business or profession during the financial year, the previous year will end on 31st March, even though the period comprised in the previous year may be less than 12 months. So suppose you start a business on say 1st June 2025. Your previous year will end on 31st March 2026, and your assessment year would be 1/4/2026, ending on 31st March 2027. So assessment year 26-27. Assessment of income of a person is a computation of income of the person from various sources in accordance with the Act. Such computation or assessment is made after allowing various exemptions, deductions, etc. as provided in this Act. Now, there is a change in the law with effect from this year, where I will be coming to that topic also, where it is now a presumptive assessment of tax, where you presume an income and then you don't get most of the deductions and exemptions, and you straight away pay tax. But otherwise, under the Act, there is a provision that you compute your total income from various sources. Then you can take benefit of various exemptions and deductions which are available to you, and your net income is then taxed. Those deductions, exemptions, we will be going through that. The source of income also will be going through that. An assessment therefore comprises of two stages. One is computation of total income, and then determination of the tax payable thereon. When both these stages are completed, an assessment is deemed to have been made. Now, what is the basis of charge of tax? How do you charge tax? Income Tax Act does not prescribe the rate at which the tax is to be charged. Section 4 of the Income Tax Act lays down that income tax shall be charged for assessment year in respect of total income of previous year computed under the Act. The rate is prescribed by the Finance Act, which is passed every year by the Parliament. Every year, finance bill is presented in the Parliament by the Finance Minister, specifying the rate of taxation which becomes effective from 1st April that year. The budget proposed by the Finance Minister and presented before the Parliament in February or March, if passed, becomes the law. It not only suggests the rate of tax, and it also gives amendments of the law. What are the changes in the Income Tax Act? Also, it covers other budgetary aspects like customs, duty, excise, GST, etc. For the next financial year, which will be commencing from 1st April. So normally when the bill is passed, it takes effect from 1st April of that financial year. Now we come to the status of a person. Under the Income Tax Act, different persons are taxed on the basis of their status as a person, residential status. So that residential status of a person is divided into three categories. One is ordinarily resident of India. One is a resident but not ordinarily resident in India. And one is a non-resident Indian. Now, in Income Tax Act, the definition of non-resident resident is different from what is under the general law or the FAMA or whatever, where non-residency status is different. Citizenship, for example. Section 6 deals with residence of a person in India. It is different for individuals and for entities like firms, AOPs, HUF companies. An individual will be treated as a resident in India in any previous year if he fulfills any of the following two conditions. He is supposed to be in India for a period of 182 days or more in a year, in a previous year, or within 4 preceding years, he has to be in India for a period of 365 days or more. And he has to be in India for 60 days or more in that previous year. So it is alternative. Either you be in India for 182 days or more, or otherwise in 4 preceding years, you be in India for 365 days or more, and you be in India for 60 days or more in that particular year. An individual who is abroad, either working abroad or is resident abroad, but of Indian origin, he would be treated as a resident of India if he stays in India in that previous year for 182 days or more instead of 60 days. This comes in the second category, B, what we said, that in the previous year, 4 preceding years, you have been in India, and then instead of 60 days in that year, you would be a resident only if you are more than 182 days in that year. So if you stay abroad for 182 days or more, you are a non-resident Indian. However, if total income of any such person other than his income from foreign source exceeds rupees 15 lakhs during the previous year, he will be regarded as resident if he stays in India for more than 120 days instead of 60 days. So now you came from 60 days to 182 days and now you're back to 120 days. If your income is in India is more than 15 lakhs, an Indian citizen or person who permanently resides outside of India and only visits India in any previous year will be treated as a resident in India if he stays in India for 182 days or more. Otherwise, he's a non-resident. So if you are a citizen of USA or UK or UAE, you have a foreign passport, but you are of Indian origin or not. But if you stay in India for more than 182 days, then you would be a resident in India, irrespective of what you are. Residence of a firm or an AOP or HUF will depend on the control and management of its affairs. If the control and management of the affairs of the AOP is within India, it will be treated as a resident in India. For a company, it would be treated as a resident in India if the following two conditions are met. A, it is an Indian company, or its place of effective management in that year is in India. A resident but not ordinarily resident in India is accorded only in respect of an individual or HUF. So resident but not ordinarily resident is not applicable to AOPs, companies, firms, HUF, trusts, etc. An individual will be treated not ordinarily resident in India in any previous year if that individual has been a non-resident in India in 9 out of 10 previous years preceding that year, or during 7 previous preceding years, then that year he is in India for a period less than 730 days. That is 729 days or less. So all this I am reading because there are short notes, questions asked on this. You study this part. Resident, ordinarily resident, or resident but not ordinarily resident for an individual and HUF. HUF is treated as a resident but not ordinarily resident if the manager of the HUF has been non-resident in India. Manager would be a Karta. So same principle, the Karta, if he resides for 9 out of 10 previous preceding years, or is during the 7 years preceding that year been in India for a period less than 730 days. We have just one matter just now where a question has arisen that a Karta, if he is staying abroad, would the HUF be treated as a resident or a non-resident? So we have to now check based on this definition that if the Karta has been out of India for more than 9 years out of the 10 years, or in the 7 years he has been out of India for 730 days or more, then only that HUF will be a non-resident, otherwise it will be resident. Now, non-resident Indian. So an individual who does not satisfy the conditions for being a resident in India or a resident but not ordinarily resident is a non-resident. HUF firm, AOP, etc. is treated as non-resident in any previous year if the control and management of his affairs is situated wholly outside India. Company will be treated as non-resident if it is not an Indian company or its place of effective management is not in India. Now we come to the scope of total income under section 5. A person who is a resident and ordinarily resident is chargeable to tax on all incomes. Which incomes? The one which is received or is deemed to be received in India, which accrues or arises or is deemed to accrue or arise in India, or which accrues or arises outside India. So you are taxed not only for what you receive, but for what it accrues or arises, or it is even deemed. So there is a deeming provision, an assumption that there is an income arising in India, or which accrues even outside India. In case of a person who is resident but not ordinarily resident, the scope is the same as in the case of person who is resident and ordinarily resident, except that the income which accrues or arises outside India is not includable in the total income unless it is derived from a business controlled in or a profession set up in India. So this exception you must note that for both it is same except that income which accrues or arises outside India is not includable if it is derived, unless it is derived from business control in or profession set up in India. And non-resident are liable in respect of income received or deemed to be received in India, or accrues or arises or is deemed to accrues or arise in India. They are not liable for income outside India if it is not remitted to India. Sorry, even if it is remitted to India, if the income arises outside India, they are not liable to pay any tax on that. Now, irrespective of residential status, all income accrued or arising, whether directly or indirectly, through or from any business connection in India, or any property in India, or any assets or source of income in India, or the transfer of capital assets situate in India, shall be deemed to accrue in India and chargeable to tax in India under Section 911. So one is business connection in India, any property in India. So any foreign company setting up a business here, or any businessman, for example, a diamond merchant doing business with somebody having business in India or having an office in India, anybody buying a property in India, earning income out of that property, any assets or source of income in India, or transfer of any capital asset, such as a sale of any property in India, capital asset, and chargeable to tax under Section 9. However, no income shall be deemed to accrue or arise in India to a non-resident, news agencies or filmmakers, where their operations in India are confined to gathering and transmitting news outside India or shooting films in India. So anybody who comes to make a film here need not pay any tax, even though they have some connection, business connection. This is an exception. In case of a person or individual governed by system of community of property owned under Portuguese Civil Code. Now, this is a separate section which is in force in state of Goa or in the Union territories of Dadra and Nagar Haveli, Daman, Diu. There, under this Portuguese Civil Code, whatever is owned by the husband or the spouse half of it automatically on marriage belongs to the spouse or the wife, except salary income. So in those situations where half of what is owned by a person is then shared by the spouse under this civil code, the income of the husband and wife, except salary, is to be apportioned equally between the husband and wife, and they are both to be assessed separately in their respective hands after giving rebates, relief, etc. to each one of them. This is section 5A. So, because the Portuguese Civil Code provides for this, this provision has been inserted in the Income Tax Act. Otherwise, it would be hit by by the provisions of clubbing of income, which will come to later. That's why this specific provision has been made under section 5A. Now we come to certain provisions relating to incomes of certain non-residents. Salary income irrespective of residential status, whether you are a resident, not ordinarily resident, or resident but not ordinarily resident, or a non-resident, shall be deemed to accrue or arise in India and chargeable to tax in India if it is earned in India. So a foreigner comes here, works here, he earns salary, he will be taxed in India. Salary paid to a crew member in India will depend if he is in India for 182 days or more. A person flying in an aircraft or on a ship coming here, a crew member, if he comes to India for more than 182 days or more, he will be treated as a resident. If he is in waters in the territory outside in a year for more than 182 days, he will be treated as non-resident, even if he is in India. Government servant who is a citizen of India and working in a foreign country, say a consulate person who goes there, the salary paid to him in foreign country is deemed to accrue or arise in India. However, any allowance or perquisites given to him, for example, a car and a driver or cook, whatever, some perquisite is given to him, When he is posted in a foreign country, then they are specifically exempt under section 10, subsection 7. So salary will be taxed in India, perquisites or allowances will not be taxed. Now, these are some of the deemed incomes. Dividend paid by an Indian company. Interest payable on monies borrowed and brought into India. Royalty and technical service fees payable for any technical services used for any business or profession in India. Somebody gets into a merger, acquisition, or whatever with some foreign company, a collaboration, and foreigners come here to give some technical services, charge some royalty or fees, then that person will have to be paid tax on that, whatever royalty or technical service fees are paid. However, such technical services in respect of computer software supplied by a non-resident manufacturer along with the computer or computer-based equipment would be exempt. You buy a Dell or Apple computer, it comes with some software, then that would not be taxed. For non-resident, the income shall be deemed to accrue or arise in India and shall be included in the total income of the non-resident, whether or not the non-resident as a resident or place of business or any business connection in India, or the non-resident has rendered services in India. Now we come to section 10. These are all the exemptions which are provided in the Act. These are various exemptions. Sometimes questions are asked to quote, say, 5 of the exemptions. So you can go through the list. It's a vast list. Easier way to go through this list, of course, is you have the Bare Act, or if you have what I call the Ready Reckoner, they give the list. Or there is also one more book, which is Taxman's Master Guide to Income Tax Act. You can write down Taxman's Master Guide to Income Tax Act. That gives the whole list of section 10 exemptions as well as what we will be coming to deductions, section 80. That list is provided, it becomes easier to go through it. You don't have to study this Income Tax Act, mug it and produce it in the paper. You have to understand it. Then in whatever form you write, it is fine. So I'm not going to go in detail through section 10 because it's just giving examples of where certain exemptions are allowed, like incomes, agriculture income, this income, that income, whatever. Wherever you get exemptions, you don't have to pay tax. Those list is given. You can just go through the list of those sections. So we come to the next topic, which is charitable trusts. This is under chapter chapter 3. Incomes which do not form part of total income. Now, charitable trusts or religious trusts, NGOs, they are governed by this chapter. Income of a charitable and religious trusts under sections 2, subsection 15, section 2, subsection 24, section 11, 12, 12A, 12AA, 12AB, and 30. So section 215 defines charitable purpose to include relief of the poor, education, yoga, medical relief, preservation of environment, including watersheds, forests, and wildlife, preservation of monuments or places or of objects of artistic or historic interest, advancement of any other object of general public utility. The proviso says that advancement of any other object of general public utility shall not be a charitable purpose if it involves carrying on of any activity in the nature of trade, commerce, or business, or any activity of rendering any service in relation to any trade, commerce, or business, for a cess or a fee or any other consideration, irrespective of nature of use or application, or retention of the income from such activity. So you have a hospital and you are charging patients for being admitted in the hospital or for outpatients, then that cannot come under object of general public utility or for a charitable purpose. The proviso, however, does not apply when the income or aggregate receipts from such activity does not exceed 20% of the total receipts of the trust or institution undertaking such activity or activities in the previous year. So you have a dharamshala, for example, where you are renting out rooms, but most of the time you allow people to stay there free, and only 20% or less than 20% you charge them for cleanliness or whatever. Then it would be free. Otherwise, that also would not be for any charitable purpose and you would be taxed. Now, if a voluntary contribution is made with a specific direction to form part of the corpus of the trust, so income of a charity trust, when is it exempt? That is what these sections provide. So it says that if somebody gives a contribution, somebody donates an amount and says that I am giving you so that this will form part of the corpus of your trust. It will not be treated as a general income and will not be included in the total income of the trust and you will not be taxed on that. But if that donation or contribution is from some anonymous person who doesn't have a PAN number, he just comes and gives some amount in cash in the box in a, say, temple, Tirupati temple, somebody puts gold or goes to Lal Bagh and puts gold, then that whatever receipt is there, it cannot be treated as exempt. It will be taxed at 30% of that value. So it is very important that if you are advising your client about charitable trusts, then you must inform that if they are taking any donations towards the corpus, they must take details of that person, PAN number, source from where he got the monies, whatever, so that the trust is not taxed. Income derived from property held under trust wholly for charitable or religious purpose is exempted. So whatever income a charitable trust or religious trust will earn will be exempted provided 85% of the income is applied for charitable purpose. So if you earn 100 rupees, if you get a donation of 100 rupees, 85 rupees has to be used for charitable purpose. Income in the form of voluntary contribution made with specific direction, like what we discussed earlier, to the forming part of the corpus, then that would be exempted. And trust has made an application in Form 10A for registration with the Principal Commissioner within 1 year from the day of creation of the trust. And the trust is registered under Section 12AA. So these are the conditions. If these conditions are met, then only your income is exempted. Apart from registering the trust as a under the Public Charitable Trust Act, it is also required to be registered under the Income Tax Act. So all trusts have to be registered not only under the Public Charitable Trust Act, but also under the Income Tax Act. Earlier, the registration was under Section 12 into bracket A. With effect from 1/4/1997, registration was under Section 12 AA. Now there is a fresh registration required under Section 12 AB with effect from AY 2022-223. So you must advise your clients who wants to form a charitable trust that this registration is a mandatory requirement. Now we are coming to another topic, which is a new tax regime which came in the budget of the year 2020. So there is an old tax regime and a new tax regime. What is an old tax regime? The old tax regime is a traditional tax system in India where a taxpayer can take benefit from various deductions and exclusions to reduce the taxable income. This is what I had earlier on in the opening mentioned, that a new and old system of taxation is introduced. This is the old tax regime where you calculate your income from all sources. You take advantage of all deductions and exclusions, reduce your income, and then on the net income you pay tax. These exclusions are mainly under Section 10 and deductions are mainly under Section 80. It should be 80, not 18. 80. So error in the tax slabs under the old regime were as follows. So in the old regime, if your income was up to 2.5 lakhs, there was no tax. Income between 2.5 to 3 lakhs, 5%. But for senior citizens and super senior citizens, there was no tax. Now, senior is above 60, super senior is above 80. Income between 3 lakhs to 5 lakhs, it was 5%. Again, there was no tax on super senior citizens, but senior citizens were included in this. Income between 5 lakhs to 10 lakhs, it is 20%. It was 20%. And income above 10 lakhs was 30%. These were the old slabs where if you go by the old regime, calculate and assess your tax, take advantage of deduction exclusions and pay on net sale and net income. Now we go to the new regime. What is the new regime? This is introduced in 2020 with a lower tax rate across various income levels. Under this new regime, most of the exemptions under Section 10 and deductions under Section 80 have been removed and cannot be claimed. Tax slabs are as under, which is now it has again been changed from 1/4/2025. Up to 12 lakhs, there is no tax. Between 12 lakhs to 16 lakhs, 15%. Between 16 lakhs to 20 lakhs, 20%. Between 20 lakhs to 24 lakhs, 25%. Above 24 lakhs, 30%. So earlier, about 10 lakhs, we were paying 30%. Now up to 12 lakhs, there is no tax. But then you don't take any benefits. So nothing is more or less deductible in your total income. You pay tax on the total amount. The parameters, so this is a distinguishing factors which I have carved out between old tax regime and new tax regime. Tax slabs, higher tax slabs in old tax regime, lower tax rates in new tax regime, deduction exemptions, multiple deductions and exemptions for various investments, expenses, and savings. These include deductions under 80C, 80D, 80E, and house or rent allowance, etc. Under the new regime, limited major deductions, exemptions only. Complexity. The old tax regime is very complex due to various deductions, exemptions, calculations. this is much simpler. There are hardly any deductions or exemptions. So it's a simplified tax filing. Tax planning requires a lot of structured tax planning. But in case of new regime, considerably reduced tax planning needed. Savings encouragement. Earlier tax regime encouraged savings through tax benefits. So once you suppose for example, 80G was a tax saving. If you make donation to a charitable trust, 50% of your income or the donation that you have given would be reduced from your income. Same way 80C, where you invest in PPF or NSC or LIC policies or whatever, 80D. So those benefits you could take of tax savings and then reduce your income and pay tax that way. But now under the new regime, because the tax rates are lower, there are no such incentives for opting for savings, because you cannot take advantage of such schemes like PPF, NPS, etc. Those deductions under 80C, 80G, etc. are not available now. Now we come to main topics under the Income Tax Act. Heads of income. So these are the various sources from which your income is computed under the Income Tax Act. There are 5 heads of income. Salaries is the first head. Income from house property. Profits and gain of business or profession. Capital gains. Income from other sources. That is what is called a residuary. Now first we'll deal with the first head of income, salaries. Salaries is under section 15. Income under the head salaries comprises of remuneration in any form due for personal services under an express or implied contract of employment of service. There has to be a relationship between an employer and employee. A partner who receives salary or remuneration is not an employee of the firm, and therefore there is no contractual relationship between them, and hence a salary or remuneration paid to a partner of a firm is not included under the head salaries, but it would be included in income from other sources or business income for him. Explanation to section 9(1), subsection 1, subsection Roman 2 clarifies that income under the head salaries for services rendered in India shall be regarded income earned in India even if it is paid abroad. This we did it earlier also when we were talking about non-resident Indians taxation. Now, what is a salary? Salary will include salary received during the previous year, whether paid or not. Advance salary, arrears of salary, wages, annuity or pension, gratuity, fees, commission, perquisites, profits in lieu of salary, in addition to salary or wages, leave salary, amount paid by employee to employee towards contribution to EPF, Provident Fund, in excess of 12%, interest exceeding 9.5%, dearness allowance, commission, bonus, compensatory allowance, fringe benefits. I hope I'm not boring you guys. I think you should switch on your mics and say something if.
No, sir, it's
Sir,
going
not at
good.
all.
It's a good pace, sir. And we are understanding.
Okay, thank you. So this is what salary includes, so many things. Then perquisites and fringe benefits. What is that? Now, perquisites and fringe benefits are classified under section 17 in subsection 2, such as reimbursement of medical expenses, house rent allowance, residential accommodation, motor car, transport, cook. sweeper, gardener, watchman, personal attendant, gas, electricity bills, water supply, educational facilities for family members, etc. These are all perquisites and fringe benefits which forms part of salary. Now, these are some of the exemptions under section 10 relating to salaries. So section 10, subsection 14 excludes certain allowances paid to an employee. Section 10, subsection 10B excludes retrenchment compensation. Section 10, subsection 10C excludes certain voluntary retirement benefits. Section 10, subsection 10D excludes superannuation fund payment. Section 10, subsection 10AA is an exemption for encashment of own utilized salary. Unutilized, it should be. Unutilized salary. So suppose you have done some like work, you are entitled to certain leave, but you have not availed of that leave and you have paid salary in lieu of that leave, then that is exempt under this section. Deductions from salary. Now there is a standard deduction which is available with effect from 142025. That standard deduction is raised to ₹75,000 per annum. So up to 75,000, you can deduct it from your total salary and there is no tax on that under section 16, subsection I. Under section 16, subsection 3, any tax paid on employment such as profession tax is allowable as deduction. TDS on salaries will be part of the second lecture on tax. So I'm not going to deal with TDS. So this was basically on salaries. We don't have to do much calculation in salaries. What is includable and what is not includable is basic for salaries. Only thing that now a person can choose between new regime and old regime. He can calculate and say, okay, whatever is cheap, whatever where I'm paying less tax, I can take that benefit and go under that regime. Income from house property. This is a topic which in a way helps solicitors because we do a lot of leave and license agreements, etc. Rent agreements, tenancy agreements. So any income earned from a house property is covered under this. What is a house property? It consists of a building or land appurtenant thereto. The land may be in form of a courtyard or a compound forming part or parcel of building. Such land is to be distinguished from just an open vacant plot of land. So there has to be some house or some structure standing on the land. Otherwise, it cannot come under house property if it is a vacant land. Any rent received from vacant plot of land or an agricultural land is not accessible as income from house property, but it could be income from other sources and chargeable under section 56. Suppose a vacant plot is given on rent for hire, like for a wedding or for say we keep those large, what do you call this? Containers. For storing containers. Land is given on hire or keeping something else. Storage, warehouse. Then if there is no structure and it is just a plot of land, it may be treated as income from business or profession of that person. So, but it will not be treated as income from house property because it's a vacant plot. A house property has to have a house there, some structure. Section 22 read with section 27. It deals with income from house property and excludes any house property or any portion thereof which is occupied by the owner for the purpose of his business or profession. So I just mentioned to you, suppose there is a structure and a land and where it is given to rented out as a godown or a warehouse, and in part of it you are staying, then that income would not be treated as income from house property, but it would go as an income under the head income from business or profession, profits and loss from business or profession. You may find several persons having a shop outside and staying behind. So those kind of houses, if that income what he is earning from a shop, which he runs outside, a pan bidi wala, and then he's staying behind, then that would not be his income from house property, but again an income from profits and gains of his business or profession. Expenditure incurred on repairs, municipal tax, etc. can be claimed as deductions against income from business or profession by such person, and even depreciation can be claimed. So these are deductions which you can claim from the income from house property. So if you carry out any repairs, the taxes that you pay, or the depreciable value of your property. Now, in case an owner lets out his or property to an employee for residence, and such letting out is incidental to carrying on his business. Company is letting out properties to employees, then such an income of letting out would be accessible as profits and gains from business or profession, and not under the head income from house property. Who are liable to tax under this income from house property? Under section 22, it is the owner of the house who is chargeable to tax in respect of any income owned by him from any house property such as rent, license fees, etc. So it's the owner who is responsible to pay. One. Under section 27, there are some other owners who would be deemed to be owners of house property and charged to tax under the head income from house property. So they are not actual owners, but they are still charged under this head, under the deeming provision. So if individual transfers without adequate consideration a house property to his or a spouse or to a minor child, not being a married daughter, the income from house property so transferred would be deemed to be included in the income of the person who transferred the property, despite she not being owner. This is one of the topics of clubbing of income. But it is covered here also because it deals with income from house property. So person gives his property and transfers it as a gift to his wife or to his minor's child, and then lets it out on leave and license basis, then the income would not be of his wife or the minor child, but would be included in his own income. A holder of an impartible estate is deemed to be individual owner of the property comprised in the estate. A member of a cooperative housing society or company or other association of person who has been allotted or leased a building or part thereof under a house building scheme is deemed to be owner of such building. A person who is allowed to take or retain possession of a building or part thereof in part performance of contract under section 53A of TOPA would be deemed to be owner of house property despite title not being transferred. So you enter into an agreement for sale, you take possession, pay the amount, but the sale deed is not done, so the title is not transferred. You are deemed to be the owner of that house for the purpose of taxation. A person who acquires any right in or with respect to any building or part thereof by way of sale or exchange or lease for a term not less than 10 years, but excluding any right by way of lease for month to month or period not exceeding 1 year, is deemed to be the owner. Once you take property on lease for more than 10 years, you are deemed to be the owner only for taxation, not in under the Transfer of Property Act. Even in Stamp Act, they charge you for that lease on that basis when leave and license is for more than 5 years. But that doesn't make you a lessee. Same way here also, it doesn't make you an owner in law. But for taxation, you are deemed to be an owner and you are taxed for that. So these are the persons who would, despite not owning the property, would still be considered as owners and would be taxed under this income and would be assessed for that purpose. Now, for purpose of charging tax under the head income from house property, one has to look at the annual value of the property, which is to be computed under section 23, subsection 1. Annual value is a sum for which the property could reasonably be expected to be let out from year to year. That is, to give it on rent or hire, including giving it on leave and license basis. So if a house property is given on leave and license basis, the license fees is taken into consideration for fixing municipal valuation. That is called a rateable value. Same way annual value is calculated. So if the actual annual rent or license fee is higher than the rateable value calculation of the municipal corporation or the stamp valuation, and the bona fide annual value would ordinarily be determined with reference to the municipal rateable value on the basis of which municipal tax is levied. Under section 23, subsection 5, if a builder or developer retains any building or land appurtenant or any part thereof as stock in trade. So normally a builder, when he builds a building, the flats which he owns is treated as his business stock in trade and not as his capital asset. So when he treats that as a stock in trade and he does not let out the same during the whole or any part of the previous year, then the annual value of such property will be nil for a period of 2 years from the end of financial year in which the certificate of completion of construction is obtained from the competent authority. So from completion of the building for 2 years, his income will be treated as nil. After that, even that stock in trade will be based on annual value. He will have to pay tax for it. If the property is self-occupied under section 23, subsection 2, 23 subsection 3 and 23 subsection 4, the annual value of such house or part house is deemed as nil. So if you are occupying your own house, then there is no income. There is no deeming provision. If it is in occupation of the owner for the purpose of his residence, the conditions are that it should be owned and occupied by the owner. It cannot actually be occupied by the owner, or if it cannot be actually occupied by the owner due to his employment, business, or profession carried on elsewhere, and he has to reside in that place in a building not belonging to him. So even if it is owned by you, but due to your employment or business elsewhere, you have to reside in some other place which does not, and you are residing in some place where you are paying rent and that does not belong to you, then your income would be treated as nil. Interest on any loan taken by a person to either construct or purchase a house property is available as a deduction from his income from house property under section 24. There are maximum of 2 houses are permitted to be held by an owner for his occupation without it being charged under the income from house property. Any additional house or houses other than 2 houses, even if not occupied by the owner or not let out, will be deemed to be let out and charged to tax on the basis of annual valuation. Any loss of income in case of expenses towards taxes or repairs, etc., more than income from the house property, such loss can be set off under section 71. We'll be coming to that topic also later. Set off of losses and carry forward of losses against other heads of income. So you can carry forward any such loss of income in the same assessment year. So if you are owning an old tenanted building where the rents are meager and taxes exceed your actual income from rent, then those losses you can carry forward or take a set off against your other heads of income in the same assessment year. And in case you cannot set it off, it can be carried forward and set off against other heads of income for a maximum of 8 succeeding assessment years. Loss arising on account of interest on borrowing funds for purpose of acquiring the property is also allowed to be set off in the same assessment year. In case of self-occupied property, however, maximum deduction available is 30,000. Property owned by co-owners. So section 26 provides that if a property is co-owned by 2 or more persons and their respective shares are definite and ascertainable, such person shall not be assessed as an association of persons, but share of each co-owner will be included in his total income. And if it is occupied throughout the year by such co-owner for his self-occupation, the annual value will be taken as nil for each co-owner. So this is co-owned property, where you don't take it as an association of person, but own it separately and include it in your total income. Section 24 provides for various deductions under the head income from house property. I'm not going to go in detail for this. You can yourself go through them. What deductions I've generally already told you. There are deductions such as your cost of repairs, your insurance, whatever, something like that. All those deductions you can get. Interest on loan. Next. Now we come to the next head of income, which is profits and gains of business or profession, section 28 to section 44 DB. As defined in section 213 of the Income Tax Act, business includes any trade, commerce or manufacture, or any adventure or concern in the nature of trade or commerce or manufacture. Now we have quoted one judgment here in the PPT. This case is of Universal Plus Limited versus CIT. The prepositions which were summarized in this judgment, I'll just read it for your knowledge. You can then go through this. The citation is also mentioned. No precise test can be laid down to ascertain whether income referred to by whatever nomenclature, lease amount, rents, license fee received by an asset from leasing or letting out of assets which fall under the head profits and gains of business or profession. It is a mixed question of law and fact and has to be determined from the point of view of a businessman in that business on the facts and in the circumstances of each case, including true interpretation of the agreement under which the assets are let out. where all the assets of business are let out, the period for which the assets are let out is a relevant factor to find out whether the intention of the SSE is to go out of business altogether or to come back and same. If only or a few of the business assets are let out temporarily while the SSE is carrying out his other business activities, then it is a case of exploiting the business assets otherwise than employing them for his own use for making profit for that business. But if the business never started or has started but ceased with no intention to be resumed, the assets the assets also will cease to be business assets, and the transaction will only be exploitation of property by an owner thereof, but not exploitation of business assets. See something? Yeah, that's the next one. So this is a judgment which really deals with what is business, what is not. For the purpose of computing business income, speculation business, if any, carried on by an SSE will be treated as distinct and separate from other business carried on by. Hence, section 28, subsection 3, an explanation there to clarify that from assessment year 25-26 and onwards, any income from letting out of a residential house or a part of a house by the owner will not be chargeable under the head profit and gains of business or profession, but would be chargeable under the income, the head income from house property. This we already dealt with earlier. Profession. This is just an explanation provided under section 28, explanation 3 to section 28. Now, what is a profession? Under section 2, subsection 36, profession is defined to include vocation, income from exercise of any profession or vocation which calls for an intellectual or manual skill falls under this head. It covers cases of doctors, lawyers, chartered accountants, architects, consulting engineers, artists, sculptors, musicians, singers, not to say solicitors. Next. So business or professional income. Section 28 refers to various incomes as accessible income from business or profession which is carried on in the previous year. Section 28 also provides for certain receipts which are deemed to be profits chargeable to tax, even though the business or profession to which they relate ceased to be in existence in the year of receipt. So again, there is a deeming provision in this also. Deductions from business or professional income. Business expenditure is allowable only when any business or profession was carried on by the SSE at any time during the previous year. No deduction is admissible if the business or profession has been discontinued and not been carried on at any time during the previous year. Some of the important deductions admissible in computing income from business or profession are as follows. Rent, rates, taxes, repairs, insurance, premia, where business or profession is carried on. So the place from where you carry on, if you're paying any rent, rates, taxes, repairs, insurance, premia, that is available as deduction. Then repairs and insurance of machinery, plant and furniture, depreciation on such plant, furniture, machinery, or whatever property that is owned, incentive for acquisition of new plant machinery by manufacturing company, investment in new plant or machinery in notified backward areas in certain states, expenditure of scientific research, expenditure on acquisition of patent rights or copyrights, expenditure of capital nature on specified business. There is a judgment on that, which we have cited. Amortization of preliminary expenses, bonus or commission paid to employees. Here also in our PPT noted various sections under which they are covered. Now I'll just tell you about the. So in this CIT versus Jeffrey Menas and company, the question was whether the expenses incurred by the SSC for promotion of films, slides, advertisement films is a capital expenditure or not. So the courts have, in that judgment, Bombay High Court in 2009 has held that in our opinion, the correct test to be applied in such a case would be that if the expenditure is in respect of an ongoing business of the SSC and there is no enduring benefit, it can be treated as a revenue expenditure. If, however, and if it is in respect of a business which is yet to commence, then the same cannot be treated as a revenue expenditure as expenditure is on a product yet to be marketed. Considering the above, in our opinion, the judgment in so and so some other judgment is distinguishable. So now deductions are also dependent on whether the expenditure is of a capital nature or whether the expenditure is of a revenue nature. I will generally put an example to you that in case of lawyers and solicitors, the books that we buy, are our plant and machinery, and we are entitled to deductions from our income that we earn or professional income that we earn for what books we buy. Now, the distinguishing factor is whether it's a capital expenditure or whether it's a revenue expenditure. If it's a capital expenditure, then you can claim depreciation on that and you can write it off over a period of years. You cannot write off in the same year that you have bought. But if it is a revenue expenditure, then you write it off straight away. So now if you buy a book, would it be a capital expenditure or would it be a revenue expenditure? Now that distinction has been made on the basis that suppose you buy a book, textbook, a commentary book, then that commentary doesn't come every year. It comes, say, after 2, 3 years, 4 years. So those kind of commentaries on any tax law or on any whatever statute would be of a capital nature, and you can claim depreciation of that as an expense from your income. But there are certain books like the Income Tax Act or the Bare Acts, which keep changing every year. Every year there is a new book. So those are treated as a revenue expenditure for you, and you can claim as revenue because again next year you have to buy and again there will be an expense of that. So if you're going to incur expenses every year for that purpose, then that is treated as a revenue expenditure and can be claimed as a deduction. Unless what is to be spent over a period of year is a capital expenditure where you don't get direct deduction from your income, but as depreciation or something else. Then interest on borrowed capital, contribution towards recognized provident fund or approved superannuation fund, contributions towards approved gratuity fund, bad debts, entertainment expenditure, advertisement expenditure, professional expenditure, general deductions. Now, again, we have put some case laws. You can look at it. Bad debts is again a very important topic. It's a little bit large topic. We will not deal with it, but you can place some importance on bad debts and also depreciation from all this, because questions could be asked on that. Now this case law which we have cited, HP Mineral and Industrial Development. Yes. There the question was that can the SSE treat shares held in a subsidiary company which is ordered to be wound up as a trading loss or a bad debt? And the company said that once a company has been ordered to be wound up, there is no question of any party dealing in the shares of the company. The tribunal has come to a finding of that fact that the shares were stock in trade and has therefore allowed the loss. The loss, in our opinion, has to be treated as a trading loss. It was treated as a bad debt because you could not deal in those shares because the company had gone into winding up. Then there is one more case on general deductions, which is Hoshiari Lal Keval Krishna case. Deduction claimed on account of interest paid for delayed payment of sales tax and ESI contribution. That would be an amount paid in the nature of compensation and is allowable irrespective of the nomenclature used. Whenever any statutory impost paid by an SEC by way of damages or penalty or interest is claimed as allowable expenditure under 37(1) of the Act, the assessing authority is required to examine the scheme of the provisions of the relevant statute providing for payment of such impost, notwithstanding the nomenclature of the impost as given by the statute, to find out whether it is compensatory or penal in nature. The authority has to allow deduction under section 37 subsection 1, which is general deductions. We go to provisions relating to demerger of company. I have taken this topic specifically because nowadays a lot of corporate law solicitors are doing, a lot of demergers are happening. So this is a specific provision for demergers in the Income Tax Act. The sections are mentioned which are dealing with demerger. Demerger in relation to companies is defined under section 219AA to mean demerger pursuant to a scheme of arrangement under section 391 to 394 of Companies Act 1956. Now, of course, these sections have changed in 2013. By a demerged company of its one or more undertakings to any resulting company subject to conditions specified therein. Demerged company is defined under section 219 AAA to mean company whose undertaking is transferred pursuant to demerger to a resulting company. Resulting company is defined under section 2 subsection 41A to mean one or more companies including a wholly owned subsidiary to which undertaking of a demerged company is transferred to the resulting company, and in consideration of such transfer of undertaking, the resulting company issues shares to the shareholders of the demerged company. These definitions you must see because you can compare it with the definitions in the company's law. They are quite different, but still quite similar. Deductions in respect of such demerger are as follows. You can claim normal depreciation under section 30 to 1. Capital expenditure incurred for acquisition of patent rights and copyrights can be claimed. Amortization of certain expenses can be claimed. Receipts deemed to be profits and gains of business or profession, actual costs of assets, all this can be claimed as deductions by the resultant company. This is another topic, taxation of foreign exchange fluctuations. Yeah, somebody saying something? Section 43AA. Any gain or loss arising on account of any change in foreign exchange rates will be treated as income or loss as case may be. Special provision for computing profits and gains of business on presumptive basis under section 44AD and on profession on presumptive basis, section 44 ADA. Both these provisions are for computing profits and gains on presumptive basis, which is simplified method of computing the new regime. The computation is based on total turnover or gross receipts, and tax is payable at a fixed percentage on the presumption income based on turnover or gross. This was part of that. I think it has come here on. So in such cases, deduction allowable under section 30 to 38 are to be deemed to have been allowed, and no further deductions are to be allowed. So once you go under the new regime, these deductions are deemed to be allowed, which are under the heads of allowable as deduction under the head income from profits and gains of business. Then these deductions are under the new regime. If you go, then you are taxed on the gross receipts, and these deductions are deemed to have been allowed. You cannot take these deductions again. In case of a firm, interest or salary paid to any partner or working partner is normally allowed. Deduction under section 40B will also be allowed to the firm. Compulsory audit of accounts, section 44AB. So under section 44AB, it is mandatory for person carrying on business to get accounts audited before the specified date by an accountant. If the total sales or turnover or gross receipts exceeds rupees 1 crore in previous year in a case of business and rupees 50 lakhs in case of a profession. There is a proviso to this section which mentions that if the aggregate of all amounts received during the previous year in cash does not exceed 5% of the total amount of receipts, and aggregate of all amounts paid, including amount incurred in cash during previous year, does not exceed 5% of the total payments made, then such person is not required to get the accounts audited. Where the total sales turnover gross receipts does not exceed 10 crores or 50 lakhs, as the case may be. Second proviso says that payments or receipts by check or bank draft, which is not account pay, will be deemed to be payment or receipt in cash. So if you don't give a check which is account pay, then that is treated as cash. And the return of income filed by the due date is to be accompanied by such audit report under section 44AB. Failure to comply with section 44AB results in levy of penalty. Now we are coming to a very important topic, capital gains. I'll just take a 1-minute break. Okay, so we come to capital gains. This is, as I was saying, a very important topic for solicitors practice because particularly those who are doing conveyancing practice, because you should know what is going to be the capital gain benefit, not benefit to your client. Not for the purpose of charging fees, but to guide him properly to save his taxes. So section 45 to 55 deals with capital gains. This is one of the most important topics, most useful for conveyancing practice. Term capital asset means property of any kind held by an assessee, whether or not connected with his business or profession. Any securities held in foreign institutional, securities held by a foreign institutional investor, any unit link insurance policy to which exemption under section 10 subsection 10D does not apply on account of applicability of fourth or fifth proviso thereof. The term capital asset does not include inter alia all this, any stock in trade, personal effects such as wearing apparels, furniture, motor car, air conditioner, then 6% gold bonds, agricultural land in India, not being land situate in any area within jurisdiction of municipality, whether known as municipality, municipal corporation, whatever, or a cantonment board having a population of not less than 10,000 in any area where the distance measured aerially not being more than 2 kilometers from local limits of any such municipality, not having a population of more than 10,000, but not exceeding 1 lakh. So these conditions are there for agricultural land. These are all not included in the definition of capital asset. Capital gain is charged on the basis of period of holding of a capital asset by the assessee in any or by any previous owner and the assessee under certain circumstances. For example, a flat is owned by a person, he dies. His widow and children become entitled to that under the succession law. Now, if they sell the property, then even if they are not holding it for a long term, the period for which the previous owner, being the husband or the father who was holding the property, was owning the property, would be taken into consideration for the purpose of calculating the period of holding as long term or short term. So the period of holding capital asset is computed from the date of acquisition to the date immediately preceding the transfer. Capital assets are divided into short term and long term on the basis of holding of the capital asset. Shares and certain securities which are listed in a recognized stock exchange or certain UTI securities, if held less than 24 months, are regarded as short term. And shares and securities held for more than 24 months are long term. This has been changed. Earlier it was 1 year. Now it has been changed to 2 years. For all other capital assets held for less than 24 months, it is treated as short term, and beyond 24 months, long term. This is also again changed. Earlier it was 3 years. So if it was less than 3 years, immobile property, It was short term, more than 3 years were long. Now it has become equal for both. Capital gain arising on transfer of short-term capital asset is short-term capital gain. This is under the section 242B. And gain arising on transfer of long-term capital asset is long-term capital. This is also under section 229. This is one of the most important sections, section 2, subsection 47, defining transfer. So capital gain will arise when transfer takes place of a capital asset. So what is the meaning of transfers? The gain normally arises when a capital asset is transferred, and the gain is the difference between the cost and the sale price. Now, transfer in relation to capital asset includes sale, exchange, or relinquishment of any asset, or extinguishment of any rights therein, or the compulsory acquisition thereof under any law, or in case where asset is converted by owner thereof into or treated by him as stock in trade of a business carried on by him. Such conversion or treatment or the maturity of redemption of a zero coupon bond. The part of this definition is very identical to definition somewhere else. Can someone tell me where? They can raise their hand, we can unmute and somebody can answer unmuting. Where this definition of transfer is quite identical in some other act, not the Income Tax Act. The answers, no. Well, in the Registration Act, if you see under section 17, what are documents compulsorily registerable? It mentions these very words: relinquishment of assets, sale, exchange, extinguishment. You can check that. That is also part of your syllabus. Transfer includes possession of immovable property given without registration of conveyance deed. Section 53A, Transfer of Property Act, in part performance of contract. And also transaction in agreement to buy or sell any immovable property. Transfer of movable property is complete when delivery of possession is complete. Transfer of immovable property normally is complete only when conveyance deed is registered. However, for purposes of capital gains, transfer is treated as a complete when delivery of possession and when agreement to sell, buy immovable property is entered into, and when such agreement is itself a subject matter of the transaction. So this is under section 53A. Possession is parted with on an agreement for sale. You are in part performance of contract. Then that is treated as a transfer under Income Tax Act. You cannot say that, oh, the sale deed has not happened yet, title is not transferred, so there is no transfer and therefore tax is not payable. That argument does not hold good waters. There is this famous case of Chhatrapati Dwarkadas Kapadia in 2003, where the facts were that the person had entered into development agreement and 90% of the payment of the consideration was paid by the builder, but neither there was delivery of possession, nor was there any final conveyance deed or sale deed or whatever made, nor was the developer put in possession of the property as a licensee or whatever. But still, the tax authorities had held that no, their transfer has taken place, because what the person has to receive is only the balance 10% amount under the agreement, and therefore actually nothing is left, and it is just the recovery of money that he is supposed to do. So therefore the department treated it as a transfer and charged him to capital gain tax in the year in which the amount was paid 90%. Whereas the SSE had shown capital gains in the year when he received the balance payment and he gave possession of the property to the developer as a licensee to develop. So the dispute was in which assessment year really the tax has arisen. The Bombay High Court has held that in case of a development agreement, you never know when transfer actually takes place. And therefore, the Bombay High Court held that capital gain should be charged in case of a development agreement on the day the development agreement is executed. And that has now become the law. There are some judgments which have taken a different view on this. Some other high courts have also taken a different view, but Bombay High Court has taken this view. And this matter, I don't think so, has gone to Supreme Court, to my knowledge. So this is an important judgment if you all want to refer to. The brief notes are good enough for you for your exam, but for your knowledge, it may be important. There is this other judgment, Dr. Arvind Phadke of the Bombay High Court, where this decision of Chhatrapati Dwarkadas Kapadia was relied upon, and the court had considered that and said that the division bench judgment is binding on them. And they held that date of contract is relevant provided terms of contract indicate passing off and transferring of complete control over the property in favor of the developer. And there is another judgment of the Supreme Court in 2017 where they said that the object of section 2 subsection 47 appears to be to bring within the tax net a de facto transfer of immovable property, enabling the enjoyment of or taking color from the earlier expression transferring, so that it is clear that any transaction which enables the enjoyment of immovable property must be enjoyment as purported owner thereof. So these judgments are important for this purpose of capital gains and for your practice also. Charge of capital gains. How is capital gains charged? It is charged under section 46, 45, 46 and 47. So shortly speaking, capital gain is chargeable as income of the previous year in which transfer takes place under section 2, subsection 47. Section 45 also refers to various other modes of transfer, such as monies or other assets received from insurance company on account of destruction, conversion of capital asset by owner, treating it as stock in trade for his business, any profits and gains arising from transfer of capital assets by partner or member of a firm or an AOP or body of individuals by way of capital contribution or otherwise. So a partner who owns a property transfers it to a firm, it amounts to transfer under section 45. So there are various points which are included in section 45, which are deemed to be transfers for the purpose of capital gains, apart from what is described or defined in section 2, subsection 47. Very important inclusion in section 45 is subsection 4 with effect from 21-22 onwards, which provides that if a specified person receives, the words to be noted as specified person who receives during the previous year any money or capital asset or both from a specified entity in connection with reconstitution of such specified entity, then the profits and gains arising from receipt of such money by a specified person is chargeable as income tax of such specified entity as capital gains. and will be deemed to be income of such specified entity. And there is a formula for that. A equal to B plus C plus D, where A means capital gains chargeable as income of the specified entity. B means the value of money received by the specified person on the date of receipt. C means the amount of fair market value of the capital asset received by the specified person from the specified entity. D means amount of balance in the capital account represented in any manner of the specified person of the sum account. So there is a formula given, and this is how they will calculate. Now this word specified person and specified entity are defined in this section as referring to the definition in section 9b. 9b. So section 45 subsection 4 correlates with section 9b, which was inserted with effect from 1/4/2021, which provides for taxation of specified person. So there the specified entity is taxed under section 45(4), and in section 9b the specified person is taxed. So it says specified person receiving during previous year any money or capital asset or both from specified entity in connection with dissolution or reconstitution of a specified entity. So if a person is a partner of a firm and the firm is dissolved or there is reconstitution and he retires and he receives any money or any property or a capital asset or his capital contribution, which is more than what he had contributed, then not only he pays tax, but even the firm pays tax. Therefore, if there is a dissolution, then not only the firm, but the new partner appointed, there is a new partner appointed. In that case also, there is a tax because there is a transfer of capital asset. The firm is required to pay tax on the basis of deemed income on capital assets, so transferred on the fair market value of the capital asset on the date of transfer. So both these sections are important new amendments, taxing, and you may have to advise your clients if who are wanting to reconstitute their firm or dissolve their firm for some purpose, that you may be taxed on what you are owning. And in one, it will be treated as tax on capital gain. In the other, it will be treated as your income from other sources. 9b, the explanation shows the definition of specified persons and specified entity. One or more of its partners, as case may be, of specified entity ceases to be a partner. One or more new partners, as the case may be, are admitted in the specified entity. All partners, as the case may be, of specified entity continue with change in their respective share. And specified entity means a firm or AOP or body of individuals, not being a company or a cooperative society. Specified person means a person who is a partner of a firm or a member of other AOP or body of individuals in any previous year. Another important section is section 45(5)(a), which came into effect from 1/4/2018. This section basically states that if a person or individual or an HUF, again here not a person such as a firm, trust, company, AOP, no, not those, individual or HUF, from a transfer of a capital asset being land or building or both under a specified agreement, capital gains will be chargeable to income tax as the income of a previous year in which the certificate of completion for whole or part of the project is issued by the competent authority. And for that purposes of section 48, stamp duty value on the date of issue of the said certificate of his share being land or building or both in the project is increased by from assessment year 24-25 and onwards, any consideration received in cash or by check or draft or any other mode will be deemed to be full value of consideration received or accruing as a result of transfer of capital asset. However, there is a proviso which provides that 45(5) will not apply where SSE transfers the share in the project on or before the date of issue of the certificate of completion, and then in such case capital gains will be deemed to be income of the previous year in which he transfers the asset. So this provision, to explain you, is that suppose a person enters into a development agreement for his land and building, and in that development agreement, there is a provision where he is to be given either cash or either some constructed area, some flats. And in such event, constructed area, or it may be both together, some cash and some constructed area. And in such event, he does not sell that what he is supposed to get till OC is come, OC is received, or till completion certificate is received. Then he would be taxed for the monies that he gets when he actually receives. So if he receives the monies now, he will be taxed now. But if he receives constructed area after 4 years, then he will be taxed after 4 years in the year in which he gets. And at that time, the fair market value or the stamp valuation of those flats will be considered as his gain. So he does not pay tax now. This covers Chhatrabhuj Dwarkadas Kapadia's judgment, which we just discussed, where on entering into development agreement, you do not have to pay tax on the date of signing. But you pay tax if you take benefit of this section under as and when you actually get possession of your flats or whatever you are supposed to get after 2-3 years, the area that you are supposed to get. This is one important section which you can advise your clients. This also would, in my view, cover your, to an extent, your liability as a promoter under RERA. Because under RERA, if you give your land for development, you are a promoter. But under this section, you are taking possession after OC or after completion certificate. And therefore, you cannot be treated as a promoter. You are not sharing profits. You are not sharing area with that person. You are merely getting a consideration by way of kind. And that too after OC is received. So RERA will not apply after OC is received. So in my view, this is a good way of advising your clients to enter into development agreement if they are agreeable to take that area later. Therefore, I am referring to this section in this topic. Maybe ask questions on this topic because it is newly introduced. May have been asked also in the past. We'll go to the next. So what are the transactions not regarded as transfer for the purpose of capital gains? That is under subsection 1 and section 47. There are various transactions which are exempted from capital gain tax mentioned in the sections. It's a huge list. Shortage of time, we have already reached 1:30. Next, section 48 provides for the full value of consideration received or accruing as a result of transfer of capital asset. Then certain amounts are deductible. So these are deductions under the capital gains. The deductions are mainly expenditure incurred only or exclusively in connection with transfer of capital assets such as stamp duty, registration charges, legal fees, brokerage, etc. Cost of acquisition of capital asset or cost of improvement thereto. And that's what we dealt with, specified entity provision under section 45(4). Section 50 provides for computation of capital gain in respect of depreciable assets. Then we come to certain special provisions. Now, that we had mentioned 1130 to 130. So, would you want me to continue or do you want me to stop? Hello, is there anyone there?
So please continue.
You don't mind for another hour or so? We can complete.
Okay, no problem.
Yes, sir.
Okay, thank you. So special provisions for full value of consideration in certain cases. This is section 50C. This section is again very important section, section C. Is it small c or capital C? I think C, check. This section, I will briefly tell you. I'm not going to read this section, but this section provides that if and I think those who are now doing articles with some solicitors must have come across this also. This section provides that if the value of the consideration mentioned in the agreement is lesser than the stamp ready reckoner valuation, then for the purposes of capital gains, stamp ready reckoner valuation will be taken into account and you will be taxed on that amount and not on the amount of the consideration mentioned in your agreement. The idea of introducing this section is that if there is some black money that somebody is taking or unaccounted cash somebody is taking, then that is not taxed. So they are trying to tax that. And therefore they said that if the stamp valuation is more, then you are supposed to pay tax on the stamp valuation, which is the higher of. And if the consideration is more in the agreement than the stamp valuation, then you pay on that. So whichever is higher, you have to pay tax on. The section is 50 capital C, not small c. And there is a proviso there that if the consideration, the difference in the consideration mentioned in the agreement and the stamp valuation is less than 10%. And now I think inflation 2 years 2021 does not exceed 5%. Then they do not bother. Then it is all right. You can go ahead. Then you can pay tax on the whatever, even if the consideration is lower, you can pay tax on that. But if the difference is more than 10%, then you have to pay on the high. This is section 50C. Now, next section. Now we are coming to fair market value. What is fair market value under section 222B? So in many provisions relating to capital gains, reference is made to fair market value of a capital asset. This is the price that the capital asset would ordinarily fetch in a sale in open market on a relevant date, and where the price referred to is not ascertainable, such price has been determined in accordance with rules framed by the board. Mind you, don't get confused with annual value. Annual value is what we discussed is a rateable value or the value that somebody would fetch if your property is let out on rent or otherwise. Here it is a market value which you would fetch on sale. So that is the difference between annual value and fair market value. Don't get confused in the two. Section 50D provides that where consideration received or accruing as a result of transfer of capital asset by an assessee is not ascertainable or cannot be determined, then for the purpose of computing income chargeable to tax as capital gains, fair market value of the said asset on the date of transfer shall be deemed to be the full value of consideration received. This is in case of gift. When you give something, then that ready reckoner values go on the basis of fair market value, because there you don't know what is the value. That's how it works. Then what are the exemptions from capital gain tax? So the two exemptions under section 10 are section 10 subsection 37 and section 10 subsection 38, exemption from capital gains. Then section 54, this is an exemption that if an individual or HUF transfers is residential house. Very important, not commercial, residential house. Again, only individual and HUF, not company, firm, etc., etc. Just individual and HUF. If they transfer a residential house, and if within 1 year prior or 2 years after such transfer, they reinvest the monies to purchase another residential house, or they construct a residential house within 3 years after the date of transfer, then the amount of capital gain tax would be exempt. They would not have to pay any tax. With effect from 2024-25 assessment year, this exemption is now limited to a maximum amount of rupees 10 crores. So up to 10 crores you can reinvest, beyond that you cannot. You don't get benefit of this exemption beyond 10 crores. So if you have, sell a property and you reinvest in a property, say worth 14 crores or 15 crores, then up to 10 crores you will get benefit. On 4 crores you will have to pay tax. Now again, the other thing is that this new house you cannot sell for another period of 3 years. Otherwise, you will be charged tax in the previous year in which you sell it. Now, section 54 is a similar exemption. The only difference between 54 and 54F is that here, whatever is your gain from any capital asset other than residential house. 54 deals with residential house. 54F deals with any capital asset which is not a residential house. So if whatever, suppose you sell gold or tenancy rights surrendered and landlord pays you, or tenancy rights transferred, that is not owned by you, and therefore that is not a residential house owned by you which you are transferring tenancy rights. So tenancy rights transfer and you get some monies by check, now it's allowable. So if you take that, then that can be reinvested under section 54F in a residential house. Then you don't pay any tax. So gold, any shares that you sell, any investments that you sell, all that can be reinvestment and your tax can be saved. Again, here there is a limit of 10 crores. So these are the conditions under 54F. Same conditions, more or less. Now it also provides in 54F that if you do not utilize the amount within the time that you have to utilize this amount before you file your return for that previous year in the assessment year. So before that, if you have not utilized that amount, say you have to buy it within 2 years or construct within 3 years, and you are going to take time in utilizing that amount, then that amount has to be invested in a specified bank account for tax saving of capital gain. It's called a capital gain tax saving account or a capital gain tax saving fixed deposit. Only from that account, if you deposit before filing your return of income, then this exemption is available, otherwise not. Cost of purchase or construction of new house is not less than the net consideration in respect of the capital asset transfer. If it is more, then the difference you have to pay tax. Also, on the date of transfer, you should not own more than one residential house other than the new asset. You do not purchase within 1 year or construct within 3 years after the date of any residential house, then you cannot have that. Income from residential house is chargeable under the head income from house property, and the maximum limit is again 10 crores. So these are the conditions for 54F. Tax on long-term capital gain is also exempted in case of investment in certain specified bonds. under section 54EC and 54E to a maximum of rupees 50 lakhs. Capital gains is charged under section 112 for transfers which takes place prior to 23rd July 24. Tax was 20% and now it has been reduced to 12.5%. But the option is available to you as an SSE to choose any one of the methods. If the SSE chooses to take benefit of indexation, cost inflation index as the tax charge is 20% on capital gains arising after deduction of cost acquisition, cost of improvement and other expenses. Alternatively, SSE can choose to pay 12.5% capital gain tax arising without taking benefit of indexation. And SSE can calculate both the matters and pay tax or reinvest as per benefits available to him. So this is also new regime, old regime in capital gain. That if you want to pay 12.5% tax, then you don't get benefit of indexation. Otherwise, you get benefit of indexation and the other expenses are deducted and then you pay 20% capital gain tax. We will come to that indexation part. Certain transfers to be void, section 281. I have taken this topic, which is the last topic I had in chapter 23, not last year, today, but chapter 23A or something, where section 2, miscellaneous provisions. This is the only section referred in that chapter or in your syllabus. This I have taken with capital gain because it relates to transfer of property. So as a solicitor, we say that, okay, we are doing a sale transaction, but the seller must provide us with a tax clearance certificate under section 281. So this section 281 provides that if an SSE creates a charge or parts with possession by way of sale, mortgage, gift, exchange, or any other mode, transfers any of his assets in favor of other person when any taxation proceedings under the Income Tax Act are pending or after completion thereof, but before service of notice, such charge or transfer shall be void as against any claim in respect of a tax or sum payable by the SSE on completion of the proceeding or otherwise. Basically, it means that if somebody has some taxation proceedings pending and or has some tax dues pending and he transfers some assets, then that transfer would be void because it is a transfer to avoid payment of tax. So, therefore, as solicitors, you must take extra care if you are a solicitor for the purchaser. Mere declaration in the document that there are no taxes pending is not sufficient. You should take this precaution of asking for a certificate under 281. Otherwise, if there is a fraudulent transfer, after purchasing, your client will be left with facing a void transaction and will lose all his monies. It applies to movable properties worth more than 5,000 and immovable properties more than 10,000. Assets would mean land, building, machinery, plant, shares, securities, fixed deposit in bank. So long as these do not form part of stock in trade of any business, any kind of asset is included. While proviso says that it will not be void, the transaction will not be void if it is for adequate consideration and without notice of pendency of any proceeding or without notice of any tax or any other sum payable by the SSE or with previous permission of assessing officer. So this previous permission of assessing officer is the certificate which we ask for. So therefore, 281 certificate is an important topic which may be asked in your exam. Earlier, when the documents were registered many years back, the registration office would ask for 281 certificate and keep the document pending after lodging it till 281 certificate is produced. Now they are not insisting on that. There is a circular or something which says that this is not necessary for registration purposes. But otherwise, as a precaution, this is a good practice. Next. Then there is another. Now we come to the other topic, income from other sources, which is the last head of income. This is the residuary. If it is not covered in any of the earlier heads of income, it is covered under this. Now there is one section 56 in which income from other sources is covered. This and section 50C, there is a correlation. In section 50C, we talked about difference between the stamp valuation and the consideration received, where the transferor is taxed on the basis of what is the stamp valuation if it is higher. In 56, it is the recipient, the transferee. So if a transferee who receives the asset or a property or monies, and that property valuation is less than the stamp valuation, then he will have to pay tax on the difference in the valuation. So this is section 56. Do not get confused between section 50C, capital C, and 56. 50C, again I am repeating, is to a person who is transferring and to whom capital gain arises. It is under the head capital gains. This is under 56 is under income from other sources, residuary head, where the person who receives is taxed. So, if consideration for transfer as a result of capital assets declared or mentioned in the sale is less than the valuation adopted or assessed or assessable by stamp valuation, then value adopted by stamp valuation will be taken as full consideration as a result of such transfer. Employment of this section is that the transferor of capital asset is liable to pay tax on valuation arrived at or adopted by stamp valuation authority, notwithstanding having received less amount as mentioned in the agreement or sale deed, or having paid less amount. Here the purchaser will be taxed on the basis of the value of the property because he receives that much property worth that. The purpose and intent of this insertion is to ensure undisclosed income goes untaxed or unaccounted. Then it is to curb that. So 56.210 provides for that. Maximum permissible limit is 50,000. And beyond that, any money or property movable received by any person exceeding 50,000 is treated as without consideration. So if you pay somebody any amount less than 50,000, it's all right. But otherwise, if you give somebody as a gift or without any consideration an amount of rupees more than 50,000, then on that also it is taxed under section 56.210. Again, this concept of value of immovable property based on market determined stamp valuation is also in this case. Next. Proviso to this subsection 56.210 says that it shall not apply to any sum or money received from relative as defined in explanation to section 56.2 section 7. So in case of a gift from a relative, it would not be taxable. Now, who are relatives is defined in section 56.2.7. Similarly, there are other exemptions. Receipt of gifts on occasion of marriage of an individual, under a will, or by way of inheritance in contemplation of death. Receipt of any charitable trust or institution, or university or local authority or trust, All these are exempted under this proviso. Any transfer of any monies or assets, movable or immovable, by individual to a trust created or established solely for benefit of individual in is also exempted. So this is a private trust, not a charitable trust, but an individual that creates a trust solely for the benefit of individual or for his relatives, then it will be exempt. Definition of relative. What is this? Section 56 to 10 lays down income of every kind which is not to be excluded from total income, which is chargeable to tax. 56.2 defines sources of income to be included in the head income from other sources such as dividends, interest on securities, winnings from lotteries, crossword puzzles, races, letting out of machinery, plant, furniture, hire, forfeiture, advance for sale of capital asset, compensation in connection with termination of employment, life insurance policy, interest on bank deposits, all this comes under income from other sources. Deductions are under section 57. 58 deals with amounts which are not deductible under the head income from other sources, such as personal expenses of SSC, interest payable outside India, salaries payable outside India. These are not deductible under this head. Now we come to clubbing of income. These are deeming provisions. Here, there are sections 60 to 64, which deals with income which is not your income, but somebody else's income, but for which you are liable and it is clubbed into your income. I already explained you earlier. A man transfers his property to his spouse or child, and the income earned from that property is clubbed in his income. So these are incomes taxed in the hands of the SSC, irrespective of the fact whether he owns it or not. These are exceptional cases. Clubbing provisions are governed by these sections. These provisions are where an SSC tries to reduce his tax liability by transferring either an asset or an income to his family members, or tries to make arrangements wherein ultimate benefit of such transferred asset or income is received back by him. There are 9 such transactions where clubbing of income applies. Basically it has been introduced to curb tax evasion practices followed by many SSCs. It could also be beneficial to an SSC where there is reduction of tax liability. So it is applicable both ways. It could be in your benefit or other benefit of the department. Either way. Following are the 9 heads where and sections are mentioned where it is clubbing of income, transfer of income without transferring asset, revocable transfer of income generating asset. That means a trust is made which is revocable, where the property goes back to the person who is settling. So revocable transfers, remuneration of spouse, transfer of income yielding asset other than house property or spouse without adequate consideration. Transfer of income yielding asset. What can that was?
Someone asking, can you please share the PPT?
Yeah. Transfer of income yielding asset of son's wife without adequate consideration. Transfer of income yielding asset of SSC without adequate consideration. So all these are there. Income of a minor child. Transfer of asset by member of an HUF to HUF. Then negative income. Term income includes loss also. Hence, not only positive income, but even negative income can be clubbed. If a minor child has suffered a speculative loss in a stock market, then even this loss can be clubbed in the hands of either the minor child's parents. Head of income. clubbable income will be clubbed under the same head of income under which it is otherwise could have been taxable. The rule is our applicable irrespective of the fact whether income is negative or positive. So suppose a property is transferred and income from house property is there, then it is clubbed in the hands of the person who has transferred in the same head, income from house property. That is what it explains. Deduction under chapter 6A. Now this is 80 deductions. This entire chapter I had already said that these are all the deductions which you can claim under the Income Tax Act if you go under the old regime. 80C, 80G, 80U. There are many deductions. I am not going through them, that you can go through them. But this also can be clubbed. And you can take benefit while clubbing the income. You can take benefit of these sections also. Aggregation of incomes, section 68 to section 69D. So these are unexplained cash credits, unexplained investments made, unexplained money, bullion, jewelry. This all arises when there is a raid or there is a search and seizure operation or there is scrutiny and they find that there are some unexplained amounts. Then they would be taxed under these sections. Amount of investment in bullion, jewelry, etc. not disclosed, unexplained expenditure, amount borrowed or repaid on hundi otherwise by account pay checks. Set off and carry forward of losses, modes of set off and carry forward of losses. The process, this is chapter, I think 5A. Process of setting of losses and their carry forward may be covered in following 3 steps. Inter-source adjustment under the same head of income. So set off of one income with the other income under the same head of income. Inter-head adjustment, the same assessment year. This is only if there is a loss. The loss can be set up against other heads of income that we did earlier. Carry forward of loss. If the loss cannot be adjusted against other heads of income, it can be carried forward to another year for a period of 8 years. There are general rules and exceptions for this. Inter-source adjustments for all these losses to be adjusted and set off. Because of shortage of time, I cannot go through all this in detail. I will share the PPT. I will put it on our website or on YouTube or something. I think even this lecture we'll try and put it on YouTube because we are recording it, then it can be used. What? They are saying they want PPT. No, so we said we'll give PPT. We'll try and put it on the website or in the YouTube recording. Go ahead. So, barring the aforesaid cases, loss can also be set off against other income within the same head of income. Loss of house property can be set off against income from other house property. Non-speculation business can be set off against other income from speculation or non-speculation business. Short-term capital loss can be set off against any capital gain that way. These are inter-head. We did this, no?
No, we did interest.
These are general rules for inter-head adjustment. That was for inter. So let's go to the next one. These are also adjustment rules, various sections. Now, these are what cannot be carried forward. Loss of non-speculative business not being unabsorbed depreciation, loss of speculative business, short or long-term capital loss from activity of owning and maintaining race horses, loss from business specified under 3580. Right to carry forward the aforesaid losses will be lost if return of income is not filed in time for the year in which the loss was incurred. So if you file the return in time, it's fine, but otherwise you cannot carry forward these losses. Carry forward and set off business losses other than speculation loss. Such loss, the following propositions or points can be considered. It is not necessary that the business loss of the year one should be set off against income from the same business year two. In other words, loss of business A of year one can be set off against profit of business A or some other business in year two. Business income of spouse or minor child clubbed under provision of section 64 with income of SSE can be set off against loss brought forward by SSE in respect of a business carried on by. Effect of amalgamation on set off and carry forward of losses is under section 72A1. Demerger is under section 72A4. 79 subsection A, set off brought forward losses of a company other than a company in which public are substantially interested. And that's it then. These are other losses sections. We'll go to the next topic. This is for demerger again. So thank you. For shortage of time, I had to shorten the last topic. Is everyone there or left?
So we are there.
We are there.
Thank you very much.
We are here, sir.
Thank you. I hope I could explain you and at least something you learn. I
Yes.
don't know. This is a very topic which is more theory than practical. But whatever I could explain, hope it helps you. We'll share the PPT on
Thank you.
our website.
Yes.
I put it on website and we will maybe try and put on YouTube also. The rest of the income tax portion, somebody else will do.
Oh, okay.
Thank you so much, sir. It was very helpful.
Thank you.
And even the pace at which you went, it was slow and it was proper so that we could absorb what was being said. It wasn't going too fast.
Thank you. That's a good thing because I was wondering because topics were so many.
Yes, yes.
Cover up
No, you covered quite a lot. Like the quantum of what got covered in the three hours almost. It was quite a lot, sir. Thank you so much.
in 2 hours. Yeah. Anyway, thank you all.
Thank you
All
so
the
much.
best to all of you.
Thank you, sir.
Feel
Yes,
free
sir.
to ask questions, write to me or email me or WhatsApp me.
Yeah.
Whatever.
Sir, I have a minor housekeeping point. So I'm not receiving the emails or I'm not able to access the online access for article clerks. But I just, is there anyone I can speak to? Like I go to this and speak to the BIL staff. They're
Yeah.
not able to help me out.
No. What you do is just send email on info.at.bls@gmail.com.
Okay.
Email and you write there that I'm not registered or I'm not able to register or whatever. My name is not
Okay.
my name is this. I'm with this firm. So
Okay.
then,
Info.bils at
will
gmail.com.
yeah.
Can someone put it on the chat, please?
Yeah, just put it on chat. Info.at.bils. No, info dot, not at. Info dot. No, info dot, I'm telling you. Info dot at info dot at right? At dot bils @gmail.com. Okay. So send it there, whoever is not able to register or whatever, and we'll take up with our IT guys and see that you all are registered. And I think there
Got
is
it. Thank you so much, sir.
WhatsApp group is managed by Mr. Priyas Jani.
Yes, sir.
He is not active. Somebody else is an admin there. We'll tell him to make someone an admin there. Someone else. So then
So one question that with regards to say this, is this going to be the last time when we do this Income Tax Act and next year the law will change? So we'll have to study the new act. Let's say if people are appearing in April or
So the syllabus and the rules say that uh, the law which is applicable 6 months prior to your exam is applicable. So
right.
in case the budget comes in February, March, then those who are giving in April have to do what they have, what is the law prior to that. I mean,
Okay.
something which has come then. Suppose you are giving in October, then that budget has come 6 months prior. So then it would come into effect and you have to learn the new law. But for those who are giving in April, they have to do last year's law.
Understood.
So that means in April you will have AY 25-26 as the assessment year.
No, 26, 27 AY.
Oh, okay.
No, April. April you are saying, April exam.
Yes, sir.
April, acha, हाँ, April exam will be 25, 26.
Yes.
They don't need to do 26, 27.
Okay. Okay.
So one more doubt. So in that case, the syllabus which is there, the revised one 2019, it remains unchanged, right? Apart from the new amendments, like right now
Yeah,
today we
yes,
have
it will be the same.
yeah. So today you have completed chapter 1 to 6 and 23 section 21. So rest is 9, 10, 10A, 13, 14, 15, 16, 17A, 17B, 17C, 19B and 20, right?
Yes, yes.
Okay, sir. Thank you so much for confirmation.
I'm going to try and reduce this. There's a lot of things which are unnecessary, but some topics are really important, like capital gains, then this income from other sources, and those topics are important.
So
Salary to some extent, because if you are running a firm, you may want to know that provisions or income from house property to certain extent is important. But provision like set off and carry forward of losses and all, I don't think so. Really, it's important for our. See, this is for those who are actually wanting to practice law, practice tax. For them, this is necessary to know. And
Yes,
tax,
sir, we need to reduce because for 50 marks we have to study
yeah,
so much.
that's why I am trying to do that, because that's why we reduce. Earlier, when we gave exam, there were 3 acts: Income Tax Act full, Gift Tax Act, and Wealth Tax Act. All 3 acts we had to do for 100 marks. We reduced it to 50 only because those 2 acts are not there. Otherwise, 50 marks was always there for income tax. And
So
we,
So
by
there's
any
one
chance,
request if you can do that thing before this exam, no?
no, this exam, it's not, we have to give time to others. So there is a examination committee. We have to put a proposal to them. They will reconsider. And once they give, they agree, the syllabus will be effective from 6 months later. We have to give time to those. We can't tell somebody who's been studying suddenly that, okay, now this is not the syllabus, this is the syllabus.
Mm-hmm.
Difficult for them. Even those who have setting papers, it becomes difficult. So we have to give them 6 months time. So it will, even if it comes, it will come after 6 months, not before that.
so one more question. So you have given two books for our reference, that is IT Ready Rakhna, VG Mehta, and Taxman Master Guide to IT Act.
Yeah,
So also there is this taxation of Mr. T.N. Manoharan and G.R. Hari. So these again, these three books are, I mean, mostly related to CA. Is there any book which is for a lawyer from the past? Because in all these books there are a lot of
problems.
questions, I mean, practical questions.
Yeah,
And law aspect is relatively less. So, is there any book app per se for lawyers?
that's what I told you. You don't, you read from VG Mehta's Ready, this Ready Reckoner.
Okay, very well, sir.
I can show
Very
it to you. This is the book.
well.
VG,
Okay.
VG Mehta's Ready Reckoner, such thin book. But if you see here,
Yes,
there
sir.
are all topics given and it is taken topic wise.
Perfect.
Here also, they give first of all finance bill and what are the important amendments. Even in the Master Guide to Income Tax Act, which I told you, taxman, there are important amendments explained first
Okay, sir.
with the
Okay.
finance bill. Then there are all these list of deductions, list of exemptions. There are case laws at the back. So you
Okay,
can
sir.
choose Bombay High Court and the Supreme Court. Mark those if you want, because you are, or there are important case laws there also behind in Master Guide.
Okay, sir.
So those will be helpful to you to read. There are also certain very important topics in this Master Guide to Income Tax Act.
Okay, sir. Very well.
And
Thank you.
in this also, there are certain times, certain problems of which you can, ignore. Certain tables and things, those you can ignore. But topic wise, it covers all sections related to one topic together. For example, it is dealing with salaries. All sections related to that are put together in this book, VG Mehta.
Got it, sir. Very well. Thank you so much, sir.
I would suggest read from this and
Reaching.
keep the Bare Act with you. So Bare Act is basically for reference. You can't read from the Bare Act. It is for reference. So when you refer to something and they refer to some section and you want to check that section, then you just open that section. That is how you are supposed to be. Master Guide and this should, according to me, be enough.
Okay, sir.
Make your notes, whatever.
Yes, sir. So other statutes, I'm buying the bare acts only, like because those are like actual legal practice. So for this particular, only for income tax or registry, suggesting that get VG Mehta's book instead of the bare act.
Look, I am making it very clear. BILS doesn't suggest any books for reference or read. They don't say read from this book, read from this book, and you will be asked question only from this book. It is not like that. Solicitor's exam is not like that, that it will come only from that book. Or what I have dealt with in this lecture, it will only be asked from this lecture. Something else will not be asked. Don't take it that way. This is just a guidance to you. This is my personal guidance to you. They read from this book. It is not from BILS. This is a good book to help you. When I gave the exam, my father told me to read from this book. My father was a tax practitioner. He used to set papers. So he had told me, read from this book. Don't read from all those other Singhania and this, that. That's why since then I have been suggesting that you must read. This is much simpler for us. It is very lucid, explains very well as compared to these other books for CAs.
That is income tax ready reckoner by BG Mehta, sir, or
VG Mehta.
Acha. Or is it taxman's
No,
master?
VG Mehta. Taxman is again also a referencer, master guide. It only gives some guidance. It only covers certain topics. It doesn't cover everything.
Okay, okay, sir.
But it's a helpful book. That's why I suggested these two books too.
Understood. Thank you, sir.
But don't please again take it that, oh, you have told us this book, so now we have not read anything. Now they are asking questions from something else. Please don't come back to me and blame me for this. Whatever you want to read, read. You have to prepare. And one more thing I can guide you is, we have taken these lectures earlier. You read this and then do papers, because there are lot of topics which are repeated. When you do papers, you know what questions are being asked. Those questions are repeated in one form or the other. Short notes will become long question will become short notes. So some topics you will do, if you do 10 years papers, you will end up doing at least 7-8 times that topic. And if that question comes in the paper, you will be very confident to write because you have read it 7 times as compared to reading it 1 or 2 times or 3 times and going for an exam. So my suggestion to you all is that first go through the book, read all the law. Once you finish the law, do papers. And in papers, you read the question and try to read the answer. Don't try to just answer and then you say, oh, I don't know this, I don't know this. Either read the answer or write the answer, looking at the book. And next time you do again that same topic or same question, then you have your written answer, you can read it. That will help you all. Any other questions?
No, sir. Thank you so much.
Just one question.
Thank-
In the aggregation of income part that you told, there was one unexplained as in there were 2 3 heads that were there in the PPT. So that can that be treated as a deemed income?
It is deemed income. Aggregation of income is deemed income.
Okay.
Those are topics which are unaccounted. You have not treated as an income. So when they find it, they say that this is going to be income. So it is deemed income.
Okay. Thank you, sir.
Any other questions? Okay. So all the best, everyone. Thank you very much for joining in.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank
Thank
you
you.
so much, sir.
Thank you.